All right, we're going to talk about something that sounds, let's be honest, a little boring: corporate governance. But stick with me here, because this isn't about stuffy boardroom meetings. This is about the secret code that determines if a company is going to be a huge success or a total disaster. So let's get into it.
Trillions. With a T, that's how much investor money has just disappeared in some of the biggest corporate collapses we've ever seen. We're talking retirement funds, life savings, just gone. It's a crazy number, and it makes you ask a pretty simple question.
We all know these names, right? These companies were absolute titans. They seemed unstoppable. So what in the world happened? Was it just a bad quarter, a shift in the market? Nope. The real story, the root cause, it wasn't in their products, it was in their boardrooms.
Yeah, so these meltdowns weren't some freak accident. They happened because the company's internal immune system completely failed. The whole structure of rules and oversight that was supposed to keep them honest just broke down. And that system, it has a name.
That's corporate governance. The easiest way to think about it is it's the rule book. It's the framework that's supposed to make sure a company is run for the people who actually own it. That's you, the shareholders, and not just to line the pockets of the executives. When it's working right, you don't even notice it. But when it fails, well, that's when you get those trillion-dollar headlines. Now, for you as an investor, understanding this stuff isn't just an academic exercise, it is a secret weapon. It's like getting to pop the hood and check the engine on a car before you decide to buy it. It's a huge advantage.
The investing legend Benjamin Graham just hit the nail on the head with this one. He's saying your job doesn't end when you click buy. You're an owner now, and you've got to pay attention to how your company is being run. And the reward for paying attention? Oh, it's big.
Get this. A huge study found that, over a decade, U.S. companies with strong protections for shareholders outperformed companies with weak ones by an average of 8.5% every single year. Just let that sink in for a second. That kind of difference, year after year, can be the deciding factor in hitting your financial goals. Good governance isn't just about avoiding blowups, it's about finding winners.
So, how do we actually figure out if a company's governance is any good? Well, we're going to build a toolkit with 3 key pillars, and we're starting right at the top with the board of directors. These are the folks who are supposed to be looking out for us.
This, right here, is the most important question you can ask. You need a board that's independent enough to stand up to the CEO and ask the really tough questions. If the board is just a bunch of the CEO's buddies, well, they're not protecting you. They're just rubber stamping whatever the CEO wants.
So what does independent actually look like in practice? Here's a quick checklist. You want to see that most of the board members are outsiders. And this is a big one. The CEO should not also be the chairman of the board. I mean, think about it. If one person holds both jobs, who is that person accountable to? You also want to look out for red flags like related party transactions. That's just a fancy way of saying the company is doing business deals with one of its own board members. It's like finding out the referee in a football game also owns one of the teams. You'd probably question his calls, right?
Another little detail to watch for is how the board is elected. If they're all elected annually, that means they have to answer to shareholders every single year. It keeps them on their toes. But some companies use what's called a staggered board, where only a third of the directors are up for election each year. They say it provides stability, but it can also be a tool to protect a bad management team, making it almost impossible for shareholders to kick them out.
Okay, pillar number 2. We've looked at the board, now let's put the actual executives under the microscope. And with management, it's pretty simple. You just have to follow the money.
You see, it's not just about how much the execs are paid, it's about how they're paid. Are they getting bonuses for hitting this quarter's numbers or for building a company that's going to thrive for the next decade? It's the difference between incentivizing a mad dash sprint versus a steady, sustainable marathon. So a good pay plan always starts with an independent committee. They should be setting goals that link pay to performance over several years, not just a few months. And those goals should be crystal clear, so you, the owner, know exactly what they're aiming for. And I love this one, clawback provisions. This is the ultimate safety net. It basically means if it turns out the company's profits were a total sham, the company can literally claw back the bonuses they paid out.
And that brings us to our final pillar, which is all about empowering you. Because as a shareholder, you are a part owner of the business. That means you have rights, and you need to know what they are and how to use them.
Your most fundamental right is your vote. And ideally, you want a one-share, one-vote system. Simple, right? Your power is directly tied to your investment. But a lot of companies these days, especially in tech, use dual-class shares. This is where insiders like the founders might have special stock that gives them, say, 10 votes for every 1 vote you get.
It means a founder can own just a fraction of the company but still have total control, basically ignoring what all the other owners want.
Now, it's so easy to feel powerless here. You might own 100 shares, and the company has billions of them out there. It feels like you can't possibly make a difference. But the system is actually set up to give you a voice. You just have to know how to use it.
And here is your toolkit. You can vote by proxy, which is basically just absentee voting for stocks. Some companies have cumulative voting, which is really cool. Let's say you have 100 shares and there are 3 open board seats. That gives you 300 votes. You can spread them out, or you can put all 300 behind one candidate you really believe in, giving minority shareholders a real chance to get representation. You can also propose resolutions and sometimes even nominate your own directors. These are real powers.
So let's wrap this all up into a quick health check. When you're looking at a company, here are 4 green flags to look for. Is the board independent, with a separate chair and CEO? Is executive pay built for the long haul, not a short sprint? Does your vote actually count equally? And do you have real tools to make your voice heard? If you can check these boxes, you're looking at a company that's built on a really solid foundation.
And really, that's the bottom line. A company's stock price tells you what the market thinks it's worth right now. But its corporate governance, that tells you how it's going to be run long into the future. So the next time you're thinking about investing, look beyond the ticker symbol and ask that one simple question. Because as an owner, you have a right to know the answer.